Markets are left wondering what to do after CPI data in the U.S. seems to come in just about in the perfect Goldilocks window, a little bit softer to keep Fed rate cut hopes alive, but not so soft as to spook anybody anymore about oncoming recession. And so we get a little bit of a break in the U.S. story to look over to the world's second largest economy, China, where we have had for the past just about week or so the annual National People's Congress and hopes that it would finally do enough to revive economic growth. That's what we're going to focus on here. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. We are looking now at this National People's Congress meeting wrapping up. The last day was yesterday, and everything that we needed to hear seemingly is already out there. So now the question that we are going to be asking ourselves is, did it achieve what policymakers wanted? Did the message that come from this gathering imbue anybody with any kind of optimism that the world's number two economy will become a potent counterweight to the headwinds that we see to global growth from the slowdown in the U.S., which of course is the reason why stock markets have been in such a bad way since late February. So let's first do a bit to diagnose what the issue is here and then see if perhaps we have enough that's going to get done here to change things and what that might mean for markets overall and, of course, for our trades. So this is the issue in a nutshell. In the red is Chinese real GDP growth. In the yellow is nominal GDP growth. The difference there, of course, implied inflation. Real GDP takes away the impact of prices on the growth of the value of the economy's total output of goods and services. Nominal GDP leaves it in. So when you take the difference, you are left with that inflation adjustment. And of course, if real GDP, that is growth minus inflation, is running faster than nominal GDP, that is growth plus inflation, well, then inflation must be negative. That's exactly what you see right here. For 7 consecutive quarters now, inflation in China has been negative to the tune of nearly a full percentage point of GDP growth on average. That is, of course, an absolute indictment of the state of the economy, and indeed why policymakers in China have scrambled so significantly with such apparent energy to get the economy moving again. What this basically means is that at the economy-wide level, China is on discount. Typically, if there were robust demand, then would-be buyers of things and investors in things would be competing on price. That is to say, if I wanted to buy housing or certain consumer goods or construction equipment or anything else I might spend money on, and demand for these things were healthy because the economy were growing, other people would want to buy them too. And since output can only move so fast to satisfy everybody's demand, that increased level of activity would mean that people would compete on price, that is to say, be willing to pay more to get the thing now rather than wait for whoever makes the thing to make more of it. And so you'd get a positive inflation rate as a function of demand. If the economy is in this way, now for 7 consecutive quarters in deflation, what that means is that there isn't that pull on demand to get prices moving higher, There is instead a discounting because of an absence of demand to try to clear inventories, to try to get things that have been unsold to be bought. Now, if we look past the sort of slower moving GDP numbers to higher frequency inflation readings from CPI and PPI, the Consumer and Producer Price Index, we get the same story. CPI has dipped back into negative territory in the most recent readings. PPI has been in negative territory going back to 2022. So whether you look at GDP or you look at the headline inflation readings themselves, the implication is an absence of demand. Look at official PMI numbers. These are measures of the pace of economic activity growth. China releases two of them. There's the S&P Global version and the official version. This here is the official. This is the S&P Global. Perhaps the most interesting thing here is that the official numbers actually look worse than do the private sector estimates, which for China is a bit unusual given their at least alleged penchant to rose tint the data a bit. So now, when we look at these numbers, of course, as ever, 50 is neutral in the logic of PMIs. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. In this case, we can see both manufacturing and service sector indexes, the official ones from the National Bureau of Statistics alongside CFLP, the Chinese Federation for Logistics and Purchasing, which is a government entity. You're basically hugging 50. That is to say, the economy is at a standstill. And you've been hugging it now for quite some time. This was the reopening from COVID, where you had a bit of a jump in manufacturing, a more potent jump in services, which lasted basically into the middle of 2023 and promptly gave up the ghost. Here again are those official or those S&P Global numbers, the private sector numbers. You can see they're actually a little bit more positive here, a little bit further above 50 than are these official numbers, but nevertheless, hugging 50 and stuck in a narrow range after a bit of an upswell, in particular in services, at the beginning of reopening. A slight bump in the first quarter of 2023 and then fizzle. You can see the absence of demand across the board. If you look at consumers, in the yellow here are household time and other longer-term deposits, that is to say, savings accounts and the like. Money that isn't on demand immediately as a checking account would be, which is the red line here, demand deposits. These are immediately liquid, there to be spent checking type household bank deposits. You can see here going all the way back from the global financial crisis in 2008 to the start of COVID, there is something of a range here that holds. And then after COVID, clearly there has been a change in pace. In the blue line here is the ratio of time deposits to demand deposits, and we can see savers are tucking money away. Whatever measures we might see that officialdom has tried to get them to spend, consumers are not moved. They are putting more and more money into longer-term time deposits. That is to say, they are saving more and more relative to how much they have on the ready for consumption. You can see very clearly here after COVID, the wedge between these deposits is widening significantly. Foreign money is also pouring out of China. In fact, the year-on-year rate of decline for foreign direct investment has only recently become slightly better than 30% year-on-year, which is an absolute catastrophe. Money is practically pouring spigot-like out of China. foreign direct investment exiting, going all the way back to 2023, as though the ending of the lockdown somehow gave permission for an outflow. We can see here with the reopening a slight pop, and then very quickly by the middle of 2023, as it becomes apparent that the economy is not rebooting, you get to net outflow, and since then the pace has only become worse. Moreover, it seems like the stock market has in some ways become an outlet for capital to flee. We've been looking at the outperformance of Hong Kong markets relative to mainland markets by looking at the Stock Connect flow volumes, which is essentially a way for people who have access to mainland stocks to trade directly in Hong Kong, and for people in Hong Kong to trade directly on bourses on the mainland. And we can see here at the top in the green here, this is the volume of southbound capital flows across the Stock Connect. That is to say, money going away from mainland bourses. And we can see that thanks to that, the Hong Kong stock index is looking relatively chipper since the start of the year. Note that mainland stocks, the CSI 300 Shanghai Shenzhen index, is listless here in a range because northbound flows, that is to say capital going into mainland markets, has been going the other way, narrowing. And so it doesn't look like what we're seeing here is outperformance by Hong Kong for very much of a reason other than money is trying to leave the mainland, and with capital controls and other barriers, doing so through this Stock Connect release valve seems to be increasingly something that is occurring. So what does all this mean for officialdom? Well, they've tried to stem the bleeding. So far, all of it has mainly focused on using monetary incentives and otherwise creating inducements to free up more money for other people to spend. So boosting the stock market by direct cash injection, lowering mortgage rates, lowering bank reserve requirements, reducing overall interest rates, buying up unused land and unused housing. All of that seemingly aimed at freeing up money, making money cheaper to borrow, and in a whole host of ways, giving an incentive for there to be demand because more money has become available to businesses and consumers to do that. However, it hasn't worked, largely because confidence isn't there. As we just saw from that chart of deposits in microcosm, you can make the money cheaper. But that doesn't mean people are going to borrow, and it doesn't mean that they're going to spend. That cheaper money seems to be getting tucked into savings rather than actually going toward economic activity. This is the Bloomberg Credit Impulse Index for China. It measures the share of new loans in GDP. We can see here the share has been falling. This index coming down since, again, the middle of 2023. Here's the reopening bump here, and that has since fizzled. Moreover, the rate at which the share of new loans in GDP is falling is in the double digits, shockingly. Not too far off 20% year on year, which is, again, a scary number. So not surprisingly, the markets were very interested to see what the National People's Congress would do to finally kickstart some stimulus. And what the markets wanted was a Western-style fiscal largesse effort, where the government says, you know what, we're not going to worry about inducements. People don't want to spend. We can't convince them by making money cheaper. Somebody needs to make some demand in this economy. We're just going to go and do it ourselves. This is, of course, what we saw during COVID in much of the Western world, where governments opened up their borrowing and said, all right, we're going to take on a bunch of debt, we're going to spend a bunch of money, but the economy will not stop. And of course, that's paid dividends, in particular in the US, where the spending was most generous. US, until the latest confidence-driven misstep in growth in January and February of this year, was easily the best performing major economy and the fastest growing of the major engines of global demand by a long mile over the past year, certainly over the course of 2024, and certainly over the second half especially. So in the case of China, this is what the markets wanted. A big dose of government spending to kickstart demand. And after the NPC was all said and done, this is what we ended up with. This is a chart from The Economist that summarizes how much extra we are getting. Now, China is, as ever, an interesting case in terms of reporting its deficit. It gives a target for the headline deficit as a share of GDP, and it duly increased that target from 3%, where you can see it's been hovering for the past several years, up to 4%, which is a record high, as if to signal we are prepared to spend a bunch more money. Now, on top of this, there is special bonds, that is to say, off budget, not in the headline deficit calculation borrowing, that is nevertheless approved by the Politburo and the MPC, that can be done by local governments. Then there is more borrowing by the central government. And indeed, we can see here that the borrowing by central government sources is increasing. Borrowing by local governments is increasing. To do a quick rundown here of what officials had on offer, as we said, the official deficit target up from 3 to 4%. Target inflation rate lowered from 3 to 2%, as if to sort of tacitly admit that inflation has been undershooting and China is struggling to do anything about it. The growth target left at around 5%, so same as last year. As far as the stimulus provision, beyond that 4% versus 3% rise in the deficit target, which amounts to about 1.6 trillion in additional spending, you also have these special purpose local bonds. That issuance goes from 3.9 to 4.4 trillion, so a bit of an increase there. And then the federal government, the central government's borrowing, also sees a slight pickup in special bonds issuance. All in, that's about 1.8 trillion yuan, so a little bit higher than it was last year. But as we can see from this chart, the increase in the deficit amounts to a bit less than 2% of GDP. So if right here you were sitting at, let's call it maybe about 7, then here you're just over 8, not quite 9% of GDP overall. And the markets really wanted a spending boost of 2% of GDP at minimum just to stop deflation, then more to really get the economy going. So this was something of an underwhelming outcome. Now, you might say, well, who says it has to be 2% or more? That's just somebody's forecast. Well, that's true, but the response from the markets has clearly been circumspect enough to suggest this underwhelmed. Here's the days of the NPC right here. We can see the market rallied into it and then stalled. This is the ASHR ETF that tracks that CSI 300 index. It's not much better for the high-flying Hang Seng index and the big names there. This is FXI, the China large cap ETF, but of course all these names are listed in Hong Kong. And this outperformance here, as we just saw earlier, is the same as what you see here. This is around this apparent outflow of capital through the stock connect from the mainland southbound, and ostensibly then to other markets. So what we see here then is outperformance that isn't necessarily good news. And of course, through the MPC itself, we can see not really new optimism here, stuck and not going very far. So the markets clearly looked at this effort and said, this is not enough. This will not do it. Over the coming days, we're going to get a bunch of economic data that is going to put all of this in still more stark relief. New loans expected to come in significantly. They spiked to 5.1 trillion yuan in the previous set of these numbers, as though to signal that growth targets being met by the end of the year got papered over. But we have a significant decline to just 1.3 trillion for February. Money supply growth seen holding unchanged, but outstanding loan growth seen slowing from 7.5 to 7.4%. Total financing seen down from a whopping 7 trillion to just 2.5. So the markets are not expecting for all of this excitement to boost borrowing activity. And then all the measures of economic activity, industrial production seen slowing, retail sales seen slowing. A little bit more perhaps on capital investment, but the trend for Chinese economic data is to underperform relative to forecasts recently. And so even that might turn out to be a miss, all of which might crystallize the market's attention to, we've seen U.S. stocks fall, we've seen other stocks fall, but the one place people haven't been paying attention to and where there has been relative standstill is China. And perhaps this inability to rally, even as the government tries to sell people on a potent stimulus effort, this may be finally the trigger to get a sense of capitulation and perhaps to offer investors an opportunity to sell a market that hasn't fallen yet around these global recession fears, but which may be primed to do so. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money's back tomorrow.